All right, the news about Australian property, the tightening lending standards and credit crunch keep coming in, they keep giving. We have a hot off the press a couple of segments for you. There's an interview with the one of the developers' bosses, and but before that, there's a report on the current status of it. I mean, more importantly, I'm just going to give you a little preview of it. Is that the investor loans plunged in March by 14% compared to the March last year, and the owner-occupier dropped by 3.5%. So it's definitely cooling, but more alarming is the reason why. So watch this space.
Welcome to The Business. I'm Carrington Clark. Coming up on the program, property investors in retreat, how the big credit squeeze is putting the brakes on house prices. And $18 billion in diversified property, why Stockland says real estate is still a good investment. The retreat of investors from the property market is starting to look like a rout. Official figures show investor loans plunged in March, down more than 14% over the year. Owner-occupier interest also cooling, down 3.5% over the year. Regulators have been ratcheting up lending standards to curb runaway property prices, and the Royal Commission will force an even tougher approach from our misbehaving banks. It means borrowers are facing a credit squeeze, which also increases the risks for a faltering property market. Here's finance correspondent Philip Lasker.
19 straight board meetings without a change to rates, but the RBA governor insists he's been busy.
I sometimes read in the press that the board's job has become very easy. We just meet and we do nothing. No doubt the board members here tonight will tell you a different story.
That's because the RBA has had to find another way to balance the conflicting forces of boosting a sluggish economy while taming runaway property prices. Interest rates have been kept at emergency levels to support growth as regulators take aim at the property market by tightening lending standards.
Lending standards were too loose. If we think of what APRA and the RBA are trying to do with the Council of Financial Regulators, they're trying to put their foot on the credit fire hose, if you think of it in that terms. And so trying to put a squeeze on credit going into the housing market and household sector, and try to ease things more gently.
You know, the credit squeeze is something that is actually definitely going to cause this with the increased interest rates. I was talking to one of my mates from Ireland, and I asked him, so what was the actual reason why property prices in Ireland dropped by 50, 60, 80% in some of the regional towns? And he said nobody could get a loan. You go to the bank and you just can't get the loan. That's another name for credit squeeze. So real life example in the past that happened in America, but somehow we think it's not going to happen in Australia, of course, because we are different.
And so far, it's working.
The housing market's clearly responding to tighter credit conditions. You probably could describe this as a credit crunch or a credit squeeze, although we are still seeing owner-occupiers not largely affected by the tighter credit conditions. This is really about tighter credit conditions for investors, which is why we're seeing this flowing through to Sydney and Melbourne much more than other markets.
There's a close relationship between the supply of credit to investors and house prices. Prices started coming off almost as soon as the banking regulator, APRA, introduced speed limits on the amount of lending for investment. Then, as credit growth bottomed out, prices started to recover. But the Banking Royal Commission could well mean the squeeze will become more intense.
It's also possible that lending standards in Australia will be tightened further in the context of the current high level of public scrutiny on the banking industry. So we're going to continue to watch these issues very carefully.
Because while the Royal Commission will result in much needed changes, it also risks undermining one of the economy's key growth platforms, a property sector bloated by households with a lot of debt.
So there is the risk that we end up with a credit crunch, which economists would typically associate with the recession, that there's too fast an adjustment that comes through a change in lending standards, or the global capital markets stop funding a country or a banking system.
I think as we move through the Royal Commission on banking, the risk environment for housing is probably heightened, but I wouldn't say it's been heightened significantly.
It looks like this will become an increasingly...
All right, now this is a bit funny though. It says quick pre-approved home loans, pre-approvals, but what's more interesting is the sign below it in Mandarin, I believe. So that kind of just tells you what their target audience really is. They'd probably like to invert it and put the Mandarin up the top and English at the bottom. But that seems to be changing, and that's coming up in this report in the second segment as well. So keep watching.
Rare experience, and it's extremely difficult to determine how the engineered credit squeeze will play out and whether it threatens the broader economy.
It's again coming back to the lack of information as to what lending standards really are behind the counter when you go into the bank or the mortgage broker and you find out that a given borrower can borrow 10 times their income. These things are very hard to measure through time.
Now it's assumed the loan assessment process will be done properly. A return to prudence. That's going to hurt.
Philip Lasker there.
Return to prudence is going to hurt. Yeah, being responsible is going to hurt. Not dreaming, not doing something you shouldn't do is going to hurt, of course. It's like a recovering junkie. Once they stop taking the drugs that keep them nice and high, it hurts. However, there's obviously consequences. This next segment is an interview with the Stockland boss, and despite his very calm demeanor, just listen carefully to what he actually says. He's not denying the slowdown in the property sales for his business.
One of those most at risk of a credit squeeze is developer Stockland. The CEO Mark Steinert says despite tougher lending standards, a lack of housing supply will continue to support prices. I spoke to Mark Steinert earlier.
Yeah, the supply, lack of supply, has actually been debunked a long time ago. I've got a video on it, and current figures actually say that there's too much supply, which is why somebody like my mother said, what is going on? Months ago they were telling us how there isn't enough housing, there's a lack of supply, and now they're telling us there's oversupply, and they're starting to say that we should slow down, otherwise we're going to crash the property prices. That's what my mother said. That's really interesting. And I said, because I don't really follow the mainstream, and I'm thinking even she sees this. Although, she's an intelligent lady, she knows nothing about the markets. Same as myself, to be honest, but she noticed it. That's very interesting. So there's no lack of supply, there's actually oversupply at the moment. But let's see what the Stockland developer boss has to say.
Mark Steinert, thank you for joining the business.
Thanks for having me.
In the residential space, we know that the banks are starting to be forced to tighten lending standards. Are you starting to feel that impact? And are you worried about the future?
Well, we're watching carefully, and when we look at what's happening with our borrowers, they're continuing to operate pretty much as they have over the last 12 to 18 months. The difference is the loan approvals are taking longer, and certainly more information is being provided, but ultimately 75% of our buyers are owner-occupiers, 50% are first-home buyers. So these lending groups are certainly in focus for the government and for regulators and for the banks. The banks in particular view that those segments as good credit. They've got generally less aggressive loan-to-value ratios. These people are early, and many certainly first-home buyers early in their careers, so they've got lots of time to repay their loans. And if we look at the market overall, when we've seen interest rates declining, we've actually seen borrowers maintain their repayment rates, and they've done that and got ahead on their loan repayments. So that would suggest whatever discrepancies have occurred, more broadly, that it's not widespread. That's not the behaviour of a borrower that's under pressure and has misrepresented their expenses and their income.
In the short term, do you agree that credit growth drives prices growth? And do you expect that because we are seeing this credit tightening scenario, that it's likely prices are going to continue to fall?
Well, once again, you've got to segment the market. So credit availability and interest rates are very important, as is population growth, of course, and the relative demand supply. But if we take that point, you've already seen established house prices in Sydney and maybe a little bit in Melbourne come back, and that has reflected some tightening in credit conditions more broadly. You've also seen less appetite from overseas borrowers because of the credit changes. These aren't, recent or Royal Commission related. This is APRA and the regulator working with the banks for the better part of the last 2 years. You've also seen banks stress testing at 7% interest rates for that period of time, which had a constraining effect. Given an undersupply overall, we remain confident that we'll see moderate growth from here, and the prices outside of Sydney in our business will continue to show moderate increases of around 3.5% a year, and Sydney will probably move sideways for a year or two just because it's got more of an affordability challenge after some pretty big increases.
When you look at your own book, are you starting to see the default rate rise, or are you starting to see people pull out of offers?
No, we're not seeing an increase, any material increase in default rates or cancellations.
Not seeing any material increase in defaults and cancellations. Material. So what he's really saying there, again, in a very nice way, polite way, that they are seeing those, but they're not significant, whatever the definition of significant is for them. But they won't tell you that, and he brushes over that and moves on with his interview.
Bearing in mind that people that have generally bought homes in the last year or so, or pre-committed to buy a home, have seen a lot of equity build up in that time. So, it's highly likely those borrowers are in a very good position to get their loan approvals, and we're not seeing. We're constantly communicating with them, and they're getting their approvals, and because they're getting good valuation support.
Just how pronounced was the credit clampdown on foreign buyers to your business and to the sector more broadly?
Well, we sell less than 1.5% to foreign buyers, so it's really difficult for us to give you a read-through for our business because there is none. But we certainly saw the apartment markets, and you've seen approval levels drop off quite materially, particularly in Brisbane and Melbourne, and that's because there was a real reduction in off-the-plan sales because of that reduction in foreign participation, because they were quite a significant part of that market. Reported numbers of 30% or more of sales were going to those buyers. So that has created room for first home buyers and Australian residents to buy, and that's why you've seen nationally, while we've always been over 50% to first home buyers, nationally, if you go back 2 years ago, first home buyers were only around 8-9% of the market. They're now up to sort of 17%.
We've had disappointing.
I'm having trouble actually following what he says. He kind of gets into one side of the argument, then goes on to the other. I think he does it deliberately. What he actually said, he did spit it out finally, is that Melbourne and Brisbane, new developments, I think he said, which is units, have seen a significant drop-off because that traditionally was sold to the overseas buyers because they were only able to buy brand new off-the-plan type developments. So sorry, it was Melbourne and Brisbane. That's what he said. Melbourne and Brisbane dropped off significantly.
Official figures from the ABS this week about the retail space, but you seem to be painting a more rosy picture. How do you explain that disconnect?
Oh, he's painting a very rosy picture about everything. I mean, imagine a developer boss saying, we are panicking, the prices are plummeting, and retail sales are down, and they are our biggest customers as well, filling up our shopping centers, because these people do shopping centers and I think high-rise apartments.
Well, it's a nuanced situation. There's certain segments like apparel, fashion, and jewellery where there's been a fair bit of pressure. In some markets, there's also been
fair bit of pressure. All right, that's as much as I can take, but he's the boss of the developer. Good on him, and wish him all the best. But there's no doubt about the current status, and it's not looking good. absolutely not looking good. I mean, investor loans plummeting 14% in March compared to the last year. So that's got to tell you something. See you later.